It shouldn't be, when does my money meet my money? You've heard that before?
Yeah.
I put in 10,000 for 10 years. I got 100,000 I put in. It's only at 95. When does my money actually grow? See, the better question is, what did you do those first 10 years with your money? Did you pay off some credit cards at 28%? In the 5th or 6th year, did you go ahead and take a vacation? Hey, look, did you buy your kid braces that you borrowed money from to pay back whenever you wanted to and earn dividends on all the money you borrowed? So this is more about leverage than it is investing. You can see my screen, Brady?
Yes, sir. Yep.
Okay, so this is how I would present it. Well, first and foremost, Lafayette Life Insurance has been around for almost 120 years in business. They're based out of Cincinnati, Ohio, and they've never once missed a dividend payment ever. Ever since inception, they got paid a dividend. So everyone's going to ask me what the dividend is, what's the interest rate, and I'm going to show in an example that it's irrelevant. Because the most important thing we want to know is, how do we leverage this asset? It's not what am I earning, right? It's how do I leverage? So if I take this person that wants to pay out some credit cards as an example, and they're 30 years old, non-tobacco, you can see here that $3,000 is what I have, $250 a month. I just made it annual. But this person is going to be required to pay at least $250 a month or $3,000. That's the requirement they're going to take every year or every month, right? $250 a month. Now, this says total lump sum of $7,000. Like maybe they just had it sitting in their savings account, money market, just doing nothing, right? They didn't know it's been sitting there, right? Because you save money. Now, the good thing about Lafayette is, even though it says total lump sum, you are not required to put a total lump sum immediately. So you don't really have to have it all at once right now. Some other carriers will only allow you to put the lump sum within 60 days. Lafayette Life gives you 12 months to put in that in increments if you want to. 2,000 here, 500 here, 1,000 here. So however we design it, based upon your income and your net worth, will justify how much money you can load up throughout the year. So you don't need immediately to start a policy, but if they make good income and they have money, well, we can design it where they have 12 months to throw in extra money on top of the premium. So first and foremost, there's no percentages anywhere in my screen. 5.8, 6%, 7, because I want to let everyone understand this has nothing to do with anything related to indexing, stocks, bonds, mutual funds, nothing related to markets, anything. You get guarantees and dividends. What's the guarantee? Well, let me just tell you. If the company goes belly up and bust, they have to have a certain percentage set aside in guarantees on reserve. That's what that says. That's your guarantee if the company goes under. We focus on the non-guaranteed column for dividends, because even though by law you're not required, or they're not required to give you, they're not guaranteed to give you a dividend, we know they've never missed the dividend for 120 years. So the track record speaks for itself, right? That's why we focus on that. So if somebody on this illustration was paying $250 a month or $3,000 a year premium, and they got the extra $7,000 into this policy, you'll see that they would have contributed $10,000 of their money. And at the end of that year, the net cash value they get to borrow from this is $8,300. I don't know about you, but that's about 83% access they have that they can borrow. So if I have two credit cards, Visa and MasterCard, that I owe $4,000 a piece from, I could just go ahead and borrow $8,000, pay those two cards off that I was paying $200 a month to Visa and MasterCard at 18% interest, 22% APR. And now those are wiped out. My credit goes up, but that doesn't mean I stop paying my loans back, right?
Sure.
See, if I was going to still pay $200 each to Visa and MasterCard at 18 or 22, why wouldn't I pay the same $200 or $400 to Lafayette? Because that loan rate may be 5 or 5.5%. And how would you like to know that you're going to be earning a dividend interest credit on the full $8,300, even though you borrowed $8,000 and you haven't paid it back? See, Lafayette Life is an NDR, non-direct recognition company, versus a direct company. The difference is, when you're a non-direct, Lafayette does not recognize loans when you take them. They know you have them, but they do not readjust your dividends. So you're getting the full dividend interest credit on whatever you see in your cash value, even though you have money borrowed out. So now you're earning on borrowed funds, paying off your debts, and at the same time you make the payment schedule. So basically that's like your line of credit. And the way that this is designed, that I designed it, is that every year you pay $3,000. How would you like to know that you have access to put in $7,000 extra every single year under the MEC rule, tax-free? So you can put in $10,000 in this every single year till the day you die, if you want to do that. Much better than a Roth 401k, a Roth IRA, which you may only be able to contribute 6,500, maybe, with losses, maybe penalties. The key to this policy, so I want everyone to understand, Grady, it's not what am I earning, what's the dividend. These are more like cash on cash return. When I put my 3,000 in every year after year one, when does my money make me more money than I pay for that year? So if you look at this in year six, when I put in, or this client puts in $3,000 and they receive their annual dividend, of $1,100, basically the company is giving you $1,177 in dividends, but we're reinvesting those to buy more coverage and increasing our line of credit. So when they add those two together and subtract the cost of insurance in year six, this column that says increase in net cash value, that is the increase that they will give you in your new cash value line of credit, $3,160. So I got to ask, isn't $3,100 more than what you paid in your pocket? So now you are earning a profit on your premiums to have this asset. So are you really paying for life insurance? Because the next year after that, you put the same 3,000 in year seven, get your dividends at 1,300, subtract the cost of insurance, and now you're getting a $3,300 credit. I'm not really a big mathematician, but isn't that more than a 10% return on your investment that year? This is what compounding can do when you don't interrupt it. And the dividends you're getting, whether they're 4, 5, 6, 7%, doesn't matter. You're getting money when you pay a premium and your line of credit increases to the day you die. And this is what it would look like if you put 10,000 in every year. The more you put in, the more you get. Same thing, I didn't change it, 3,000 a year, didn't change it. All we did is add the extra $7,000 into the account that goes to cash value. That's all it is, lump sum. So now you can see that sixth year, that was the cash on cash return, has now jumped up to year 4. $10,000 goes in, your dividends are higher, subtract the cost of insurance, you got an increase in your line of credit for $10,225. The 2% return, 2.2. This is a 7.4% return, 12% return, 18%, 24% return. In the 10th year, you make your $10,000 contribution to this policy. You're making a 34% return on your investment. You show me an asset that you can contribute like a 401k, that in the 10th year, you're putting in 10,000 and that you're making a 35% return on that investment without any taxes, penalty, liability, or risk. This is what the Rockefellers use. This is what they have been using for hundreds of years. And you can see what compounding can do in the 15th, 20th year. When you're putting in $10,000 at age 50, and now you're getting a $20,000 increase, that's a 100% return on your investment.
And look at the death benefit.
Yeah, so when it comes to these policies, because we haven't discussed how they get designed, the reason why the death benefit keeps increasing, and then when you reach this 30th mark, you see where it goes from 1.1 down to 950.
Yep.
So the reason why is we don't design infinite banking for death benefit.
Okay.
So when they come to us, I don't want $1 million death benefit. We want a low death benefit, but we want to have enough death benefit under the MEC rule to satisfy the IRS.
Right.
So what we do in whole life that you can't do in other policies, only select few, is we are able to offer a term policy built into a whole life chassis and call it an optional rider. So now I have a term policy inside of a whole life, and it's an option. And now I have a heck of a lot more death benefit to satisfy the MEC, and I'm only paying peanuts for that, right? So that's how these are designed, is we're able to construct it where we're putting more of our base premium of $1,500 on the actual cost of insurance, which is like final expense. 39,000, that's guaranteed to the day you die. The cost never changes. Whether you're 30 or 130, it stays the same, 1,500. So how do we get through the MEC and put what's called paid up additions, which is more of paying up for additional coverage going right into the cash account and increasing our death benefit along the way? How can we throw in an extra $1,100 every year right into the cash value savings bucket and borrow? Well, we need more death benefit, which is why $275,000 is coming in at less than $30, $25 a month. That's how we do it. And now we have more liquidity. Now, the difference is the commission that everyone's going to ask is going to be completely different than IUL. That completely different, right? You're going to probably looking at something like this on this construction. You're probably looking at something like $1,500 on this commission, maybe half of this. So you're looking at, I don't know, maybe $1,700 on a $3,000 premium. Okay, as an example. That's how this one's. Now, this is what I use just to pay off debt, just to show you. Now, see here, this right here. A second.
I've got one good question while you're pulling that up. What's the ideal client to share this concept with?
So I'll tell you what it's not right now. It's not a final expense client, right? We'll go there. It's not really for a 60-year-old that can only pay $500 a month and that's it. Because the cost of insurance at that age is still going to eat it up a little bit. But I do have doctors and business owners that are in their 60s that are putting in $500 a month, but then they're throwing in an extra $44,000. So $50,000 every year. Like, yeah, they're using it to buy their own equipment for the dentist office, or have trucking companies that use this. So we've been doing a lot of 100,000, 200, 500,000, 50,000. So there's minimums and maximums. So this that you're looking at right now, well, I guess this is for anybody. I have it on my 3-year-old. I have 2 policies on my 3-year-old. So you can do it for a juvenile. You can do this on an adult. I'd say anywhere between 0 to 55, 60, but they have to have some kind of level of more cash to put into the policy at that later stages, because they're like near retirement, right? They need more money to load up, to leverage this asset. I'm just showing you one, I guess, idea where we can pay off credit cards for leverage, pay off lower or higher interest rates on credit cards or loans for lower ones, earn dividends at the same time. And this right here is something that is underneath the MEC rule. So if somebody has $25,000, the minimum requirement underneath the MEC rule is about $3,000 a year. So basically $3,000 a year is what they can contribute, and an extra $22,000 lets them in. If it's anything above and beyond that, it might MEC, which means it's too much cash you're trying to throw in. So I've been doing this for quite some time, so I know the minimums and maximums. So if you want to get with me, I'll show you what it is. But here's a person that puts 25,000 into the policy, whether it's immediately or throughout the year. And at the end of the year, they have access to $22,000, which is almost 90% of their money. So if they want to go buy a car for $20,000 or do whatever they want, they can borrow the money and go do that. So this is set up for anything related to a line of credit. This is set up for anyone that wants to go ahead and buy real estate, homes, equipment. It doesn't really matter, whatever it is, business owners. So if you want to leverage this, remember, it's all about leverage, not investment. So let me ask you a question. If I have someone that buys real estate, Airbnbs or rentals, and they're sitting with cash, whether it's a real estate guy, a mortgage broker, or whoever's the average avid person trying to look at to get into real estate and rentals. When you want to buy a house, let's say for $400,000, typically you got to give the bank 20% interest, right? Investment properties, 80,000.
Sure.
You either have to borrow money from your own property if you have equity to give it to the bank to get your property, but you have a loan now in your house, or you're using your own cash. And if you're spending your own cash, well, guess what? You don't have 80,000 anymore. Now you got to work to replenish that 80,000, which could take you a long time. A better way to do it is to store your capital into this asset of life insurance designed this way, where we put $100,000 into the policy. And right then we have the $12,000 annual premium, which is the minimum requirement under the MEC, that they will put in. The extra 88 will consider the lump sum. So basically 100,000 goes in, the first year's paid, done. No premiums for 12 months, fully paid. Now, within 3 weeks, they're gonna borrow about anywhere between 75 to 80%. That's what Lafayette will give you without making you wait 12 months to get your dividends. They'll accelerate that. So now I borrow $80,000 from the policy that I got approved for, and I give it to Bank of America. Bank of America gives me the mortgage, and I get Grady to rent it from me. And now, while I have Grady giving me rent, his rent is going to pay back the loan that I have, the mortgage to Bank of America, and the loan back to Lafayette for lending me their money. So while I have Grady giving me rent to pay both loans, I'm earning dividends on that $80,000 while I have him paying both my loans. Isn't that nice to leverage an asset 3 ways and borrow other people's money and earn at the same time?
What
And this person, yeah.
you
Okay.
keep putting in, I mean, hypothetically, we have a high net worth individual that wants to put in, I mean, you mentioned the dentist a minute ago, but someone who wants, oh, there we go. You want to put in 100 a month, 100 a year, 8,000. Okay, so here we go. Now we're getting now we're going big boys. Whale hunting now.
So 100,000 every year. So
Okay,
now I didn't change anything. It's still the annual premium is still 12,000. The extra 88 is going right into cash. It's just right into the cash value account where they have access to borrow it. So now 100,000 is going in every year. And now they have access to borrow this line of credit whenever they want to. So maybe they want to go ahead and do Turo. I got a couple guys that are doing Turos where they want to go buy their Ferraris or their Lambos or 2 or 3 year old cars, go rent them out so they make, 10 times their money.
Yeah.
But they're putting in $200,000 to $300,000 and borrowing out at least 75, 80% immediately of whatever Lafayette allows them to get back out. Okay. So if they're putting in $300,000 and I told you that every 100, the minimum annual premium has to be 12, then just multiply that by 3. So they're paying $36,000 a year minimum in order to put in $300,000. You just take this number, you multiply it by whatever it is. We can go up to 5. So Lafayette will allow you to put 500,000 into this policy every year. Some other carriers only get you 250 as their max. So now my contractor that we have for $500,000, we can go ahead and put this in. He's paying $75,000 a year. But when he puts the 500,000 in, he's going to borrow 350 right back out to go get his materials, his projects, his developments. And he's still going to earn dividends on the full cash value, even though he borrowed out 350. And when he has his deals up and running, he can sell them, put the loan back, and now he's got profit. So you can do this all day long with whatever. So let's just say that you don't really want to do real estate. You want to do investing or whatever it is. Well, would you rather invest your money into crypto or the stock market and lose it? Or would you rather put money into an asset that you can borrow a big percentage out? So if I put $100,000 into this asset and I borrowed 50,000 out to go buy Disney stock at $100 a share, can't I just wait for Disney to go up to 120, sell that stock, pay my capital gains, and put the loan right back into the policy, and now I have profit? Or what if I borrow the money out of this asset, go buy crypto at $50 a coin, and then that thing goes down to 25? Well, guess what? I still own the coin, and I'm still earning dividends on all that 50,000 I borrowed out anyway. I just got to wait for Bitcoin to go back up to sell it, make a profit, and put my money back in. But now I'm earning dividends while I'm waiting for that asset to appreciate, to sell, to put it back. So now I'm playing smart with my money, not just giving it away and praying that it actually goes up or down. So this is all leverage. There's nothing to do so much with death benefit. It does increase, which is good. This also does come with tax-free long-term care. So if they can't qualify for 2 out of the 6 activities of daily living, right, they do get chronic critical terminal. So they get it from day 1 or throughout their life, natural causes or whatever it is. They'll give them a lump sum or periodic payments. So it has all the long-term care benefits. It has the tax-free benefits. It has the leverage of loans. So sometimes you're going to underwrite for these. They have, just so everybody knows, they have accelerated underwriting. I don't recommend clicking that button because only a really minimum select few ever get it. I just anticipate they're going to be doing the blood and urine. And I tell the client, you're going to have a nurse come out, they're going to draw blood and urine. It's just final. They're going to do it. Right? Because I see a lot of agents doing the other one. Right? Accelerated. I don't want to wait for it. Let me just get it done quick. There's not going to be too much acceleration in these underwriting. So, just to let you know.
Yeah, I mean,
So
I think
that's
the concept of simplified issued is fantastic for when we're trying to do something simple. 10, 20, 30, 40,000 a whole life, 100, 200, 500,000 of of term, but you're trying to bank on yourself for the next 30 years. It just is a little more involvement, right? Just like we talked about earlier. It's, they're doing the character assessment. That's just, there's more bells and whistles. So it just takes a little bit longer. So have patience with it. But
correct.
the value
A little different. I'll do one more thing before I let you go, because this is something I love doing to see what everyone says. So this is very simple because everyone's always asking me, what's the dividends? What am I earning? And they also ask me, what am I borrowing the money out? Because they want to see what the arbitrage, that word, right? The spread. What am I earning? Am I making money? Am I losing money? So I don't really answer the question when I get it. I simply ask them a question. Let's just say that you have $40,000 sitting in your bank right now. And let's just say you don't want to use your cash to buy that car for 40 grand. You'd rather borrow it from Wells Fargo. So now you simply ask Wells Fargo for a $40,000 loan, and they tell you that they're going to charge you 6% on that loan. And then next week you walk into that same bank and they say, look, Ray, you've been such a good client of ours for many years. If you move your 40,000 into this new private account we have set up for 5 years, we will give you 4%. So you're kind of taken back for a little bit. I don't understand. I mean, this is math. If you're charging me 6, but I'm only earning 4, I must be losing money, right? Probably. People would say what, 2% maybe on that? I think everyone here would probably agree with me. Now, when we understand how money works, which is what I'm about to show you. Oh, where is it? So if we have $40,000 and we're getting charged 6% at Wells Fargo for 5 years, that means we would be paying $46,000 in change out of our pocket, right? And then when we walk back into Wells Fargo, we're going to pick up our 40,000 for 5 years, earning 4%. And they're going to hand us a check for almost 49,000. So you paid 46, but you received 49. Did you make money or did you lose money? So now everyone understands you actually made more money at a lower interest rate than what they were charging you at a higher one. Because when we understand how compounding money works, right? Money on top of money. Now we'll understand that any loan you have, you're paying part principal and interest amortized. So you're not really paying the full 6%, but you thought you lost money. And that's what everyone's always said to me. So now when they ask me about what am I earning at, what am I borrowing at, it doesn't matter. The better question is, what are you doing to leverage that money? That's the key. This is leverage. This is not investing. This is not what am I earning? What am I borrowing? What's my death benefit? How can I leverage an asset and still earn a dividend interest credit on all the money I borrow? That's the truth. It shouldn't be, when does my money meet my money? You've heard that before?
Yeah.
I put in 10,000 for 10 years. I got 100,000 I put in. It's only at 95. When does my money actually grow? See, the better question is, what did you do those first 10 years with your money? Did you pay off some credit cards at 28%? In the 5th or 6th year, did you go ahead and take a vacation? Hey, look, did you buy your kid braces that you borrowed money from to pay back whenever you wanted to and earn dividends on all the money you borrowed? So this is more about leverage than it is investing. So, yeah.
So if we had being a lead-based business, being a referral, based business, being a producer-based company, we meet a lot of people, right? And so a lot of times we're just checking the initial boxes of whole life and term. Now we're fishing for FIAs and IULs, right? Bridget's got a great line she's coined of one IUL a week and one annuity a month, right? Great, simple concepts. We're looking for money to put over here. For seniors, we're looking for people who do well financially to potentially put IULs in place. Now, say hypothetically, we have, we've got some bigger concepts, right? And I think you open a lot of minds of, hey, you've got a guy that's saving some money, the dentist, the business owner, et cetera. Who's our starter client, right? Bunnies, bunnies eat at the bears, right? We need to get our agents educated on this incredible concept, which doing more. And, me going to knock on my neighbor who's a dentist and going, hey man, give me $100 grand a month. I mean, I'm going to screw it up, but me have a buddy who maybe saves $3 grand a month or $3 grand a year into a bank account, or, who's my ideal starter client? So we can just get some hooks in the water, start to learn this and go, okay, I did this one and now I can level myself up. So give us a couple of ideas.
The way that I would go about it is if it's, let's say, mortgage protection, because if it's mortgage protection clients, they have a job, right? And they have a house, because you can't get a house these days without having your income shown, right? No more stated, right? Back in the day. So I think yeah. So now it's more of those kinds of clients to ask them questions. See, there's only 3 things you ever need to sell, in my opinion, that I've been taught for 16 years in estate planning retirement services. You just need to ask a lot of questions. That's number 1. You need to be very good at painting the picture for your client, and you need to be really good at telling stories. If you can do those 3 things, ask questions, paint the picture, tell stories, you can sell anything without an illustration. But how to get the client is more about asking the questions about, when you get income, where does it go? Do you pay extra towards a credit card? Do you pay extra on your mortgage? Do you pay extra for life insurance? Do you pay extra to your 401k? Let's consolidate all that money and stop giving it away and getting nothing in return. So you can get someone at $250 a month just by doing that. Instead of asking them the question, hey, Grady, here's an idea. Let me go over the presentation, the concept. What do you save in your account, or what can you invest in this type of, and that's what we always ask, right? Instead of saying, here's some questions I'm going to ask you, like a financial intake form, gather the data, and now we can show them how to capture that money, whether it be an IUL or a whole life or a blend of both, right? One for liquidity, one for investing, but $250 a month minimum is really a good starter. If they can't throw lump sums into it, don't worry, start with one. And then over the course of the next couple of years, when you increase your income and your debts and all that stuff, you can get another policy. You get as many policies as you want to relative to your income and your net worth. That's what they'll allow you to. So
that's awesome.
It's $250 a month, I think.
Income based. So here's a great idea, guys. You're a business owner, right? There's going to be business purchases. You're going to have, there's going to be life purchases, and be life events, right? Why not connect with Scott and his team, or go into the FFLAMS.com and go submit, ask a specialist, and put your information in, right? We're not a company that says, hey, welcome day one, you need to buy a policy on yourself because you got to, I mean, we should be, right? We should be a little bit more of, you sell the stuff, you should have them on your own, but we're hoping that we're recruiting enough of an educated base that they understand the value and concept of life insurance enough that they've already purchased on themselves. But this to me is fascinating. And if this interests you, if this is over your head, maybe get the book, right? We've got some links. We'll have the PowerPoint below this, links to the book, et cetera, right below video. But why not get one on yourself? If you're not if you're not saving $250 a month right now in your business, buy some more leads and get on the phones, right? But if you need to get yourself to a level, like, this is a great product. And my guys who are really gung-ho selling IULs like crazy now, guess how many they own? Like 1, 2, 3 IULs, because they believe in the concept. And this is just an additional great, good. Yeah, no, please. Becoming Your Own Banker by Nelson Nash.
So I got a link. That I'll give to, it's for anyone. It's a I'll just put it in. It's FFL card, fflcard.com/infinite. Everyone can go to that link. I've made it very easy for a turnkey system. Now, some of the stuff is going to be on AMS when I can get it. Some of it's just right here where they can just go here, anyone. This is only for agents. So please don't give a lot of the stuff to your clients unless it's like the ebook. That book that everyone's asking for, they can go there and just download that book. I have resources. I have presentations. I have how I design the illustrations. They can go there. I'm trying to make it very easy for the agents to be self-sufficient. So, and in that link, you can go all the way to the bottom and it'll show you a client intake form. And in there, like Grady was just mentioning, is requirements, like read the book, maybe get one on yourself, learn a little bit more. And in that client intake form, even if you want to take a Grady and look through it, that intake form is all the questions that I ask the client. So that's the questions that I would want the agent to go ahead and ask based upon finances and medical to see if they even qualify, because I don't want agents wasting their time, right? Don't waste your time if they're not insurable or they don't qualify financially. Let's make sure they're qualified in order to do it. So I'm trying to make it very easy for agents to go somewhere. If they want to work with me, or any agent wants to work with me, what I've been doing for the last year and a half is I've had some agents come on my Zoom. They have my calendar or my Calendly. They'll set the appointment with their client. I'll do that whole presentation. I'll answer all the client's questions. I will do an application, even if you don't have your writing number, as long as your Lafayette contracting has been sent in, which Brady and his admin can take care of that. As long as that's been sent in, then I can put you on the application alongside me as pending. And now we may be able to expedite the number even quicker than just filling out a paper app. It's not required, but for me doing that, I've been working out some deals with agents I split where I do 25% commission. You guys get 75 to sit there, watch, take notes and learn, and basically get paid to just learn. If you want to, you don't have to. You can always submit and ask a specialist. I will always do the illustrations. I will answer your questions if you need them. But if you ever need that one-on-one help, whether it's the first time or second time or third, whatever it is, yourself or a client, I keep it all pretty much even keel. All right. I just try to help as much as I can.
Dollars to pick up pennies. Tag in the expert we have here on staff, and you know, put yourself in that position where that client's going to get protected. But Scott, this is fascinating, eye-opening. I think people are, you know, kind of excited to revisit this and then learn even more about it, guys. But this, again, is another asset, another arrow in your quiver if you're an archer, and or another fruit in your another vegetable in your basket, another meat in your fridge, right? If you're a chef, things that you can do, prepare, protect clients, solve problems for them, and become that broker, that client, that make your client for life and put them in a position where you're able to elevate that complete experience with you. This is, as we always talk about, this is your business, and it is not Scott or mine or anyone's obligation to teach. It is your obligation to learn. And the information is out there. The resources are aplenty. You know, dig into all the stuff we have, UT University, and put yourself in a position where you're giving up a short period of time. If you're new to this company or evolving in this company, there's a period of time of your life where you're going to need to sacrifice away from the things, the little habits and tasks and shows and things to learn a fascinating concept like this that could drastically change the trajectory of your entire business. So Scott, I'm beyond appreciative of your time, and thank you guys. Please reach out to him respectfully. You know, go through the trainings before you reach out to him, just so that you have a basis of what to ask him questions on. But thanks again, man. Appreciate you.
No, I appreciate you. Thank you and your team. You're awesome.